Joining me as always, my friend and colleague, Dr. Orphe Divounguy, who's back in Chicago. What's up, Dr. O? How are you, sir?
How you doing, buddy? Yes,
I am. Good to be with you. Good to be with you. Quick lay of the land. How are things in Chicago since the last time you were here? You seeing anything better, anything worse, anything different, anything new, anything missing?
I mean, no, I was on a walk yesterday. I encountered a group of police officers who told me that they finally ran out some group of thugs that were basically drag racing around the streets of Chicago. So they were very pleased about that.
That's good. That's good.
Story.
I think about 30% of my TikTok feed is Chicago street racing videos. So maybe my algorithm will change. Hey, every Monday, you offer up a column for the Center Square. It's the week ahead. It's the everyday economics column. We have a big Fed moment coming this week on Wednesday, and we certainly want to talk about that. But we're going to set aside our next episode, which we'll share with everyone on Tuesday about what we think is going to happen on the rate cuts. We're taping this on Monday. This show will go live later today. So let's talk about first of all, Fed Chairman Jerome Powell is going to speak at 2:30 on Wednesday. I believe that's 2:30 Eastern time. And we'll talk specifically about rate cuts. There is an anticipation, and just staying somewhat in the generic, because I want to get your more detailed thoughts on what you think the cut is going to be in the next episode. But it seems like the windsock is pretty full and blowing in the direction of a rate cut. Not to get hung up on the implications of that. I mean, but it appears that a lot of people are already sort of, or have been reacting in different ways. In your week ahead column, you wrote about the headwinds that builders are facing. And some of that has to be, connected to waiting for, clearer seas, right? You talk about the tailwind, and a little bit of an interest rate improvement over the last, I don't know, I think it's been the last 30 days. What are the other sort of, kind of pieces of information that are kind of in the market right now? Retail sales you talked about. And then of course, the Fed decision is coming.
Yeah, totally. So, I mean, I don't think the 25 basis point rate, mortgage rates decline that we saw in the past month is going to do much to bring builders back, this year, right? So at least starting new projects, right? So I think they're going to try to sell the inventory that's kind of accumulated this year. And so I think that's what's going to happen is I don't expect to see starts rising on a year over year basis.
Right. We're also going to get that data on Wednesday. So the housing start data will be out Wednesday early in the day.
That's right. So permits were down last month. Starts, single family starts were roughly 2.8% above last year's level, which I think is generous. Remember, the Census Bureau has, those estimates get revised all the time. I expect that number to actually be revised lower, going, for this month. So yeah, I don't see builders starting a whole lot the new projects. Remember, permits end up being starts, and then starts, right? Homes go under construction. Permits are down on a year over year basis, 6 to 7 percent from last year. So I expect the starts number to come in lower. So that's the builder situation, which ultimately means less supply of housing going forward, right? So even though the market seems to be improving in terms of bargaining power for buyers right now, right, with higher inventory, more options to choose from, lots of price cuts, and incentives being offered to them, that window could be closing because as supply pulls back, there will be support. There will be a floor on prices, and so buyers will be right, we'll be faced with the fact that there's not new fresh options on the market are not there anymore. So that's the builder report. Against the good news, of course, is rates have improved, and the improvement in rates means basically the rate buy down, the cost of a rate buy down to a builder is lower. So in terms of protecting the profit margins, they don't have to do as much to try to incentivize purchasing activity. The next report we're going to get is retail sales this week. And of course, I think that's going to be a market moving event because look, right now, the prevailing theory is that as prices increase, demand will slow, right? Prices coming from the tariffs or everything else, labor shortages, whatever you have in the economy right now, the inflation uptick, right, is expected to cool demand. That's the prevailing theory, which is why you have people like Christopher Waller talking about a rate cut, which is why, right, the Fed is leaning towards a rate cut. The labor market has cooled down, and the large impact of tariffs, which a one-time big price increase, or even if that price increase takes a little bit of time to materialize, that increase should actually cool aggregate demand because workers are not able to negotiate higher wages. And so that's the expected impact. Real spending expected to cool. So if we see retail sales, retail volumes, right, adjusted for inflation actually increase higher than expected in this report, that could actually push yields higher ahead of the Fed decision.
Well, I appreciate your thoughts as always, Dr. O. We'll call it good there. We'll come back and we'll share our thoughts on what the Fed will do on Wednesday in our next episode. So for Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics wherever you get your podcasts, and make sure that you listen to Orphe and me each week on the Center Square Radio Hour.